Hello all of you knowledge seekers and welcome back to Knowledge with Alar. Today we're continuing with Modern Value Investing by Sven Carlin. So chapter 3. Chapter 3. Defining risk the value investor way. Quote, "Unfortunately, the more complex the system, the greater the room for error." George Soros. What is investing risk? Quote, "With so much attention being paid to the upside, it is easy to lose sight of the risk." Seth Klarman. The first thing a value investor should do is assess the risk, not the expected returns. It really is possible to find investments with low or even no risk at all. It just takes time to find them. Usually, the lower the risk, the higher the return. This goes completely against the opinion of academia, but as we found from the previous chapter, the market isn't efficient. So what is risk? What market understands as risk is really just volatility, and volatility is a friend of a value investor. The most popular definition of risk, volatility measured by standard deviation. Most financial institutions define risk as a chance that the actual return of your investment will be different than your expected return. The risk is measured with the standard deviation, where a high deviation indicates higher risk. So basically they compare the past movement of the stock price to the past movement of the general market price, and they compare those two. The issue with such models is that it is so easy to manipulate data to make it seem more favorable to the investor and make it seem less risky. I will give you an example of Standard & Poor 500. If you take data from 2009 up until now, it makes it look like S&P is a minimal risk investment with nice stable returns. From this picture, you can see the uptrend of S&P from 2009 up until 2017. Nice stable growth with minimal downside. Now, if you look at the S&P for the past 20 years, things aren't so rosy at all. The standard deviation is a lot larger. It isn't a stable growth investment without a negative side. Now it has high volatility. From this picture you can see the last 20 years, from 1997 to 2017. The standard deviation is a lot higher. It's not some magical thing that only grows and grows. The potential loss for S&P 500 is more than 70%, as you can see from the last 20 years. However, most investors prefer to use the short-term analysis, and the long-term analysis is left for the boring investors, the boring value investors. But you have to keep in mind that for the last 90 years, value investors have beaten growth investors 84 years out of 90. That brings out another concept related to risk that most people don't understand. Academia states that the higher the risk, the higher the return, and vice versa. The author finds this concept completely flawed because he doesn't estimate risk with standard deviation. When the risk is highest according to the standard deviation, it might be the lowest at that time. If a business is good, the price can only drop so low. The only place the price has to go is up, therefore the risk is low. What determines your return is the price you pay, not risk. If Standard & Poor would drop 40% from its current 2,900, would you buy it? Most people wouldn't, because they would be afraid. But if it would drop 40%, the risk would be smaller, not higher. Yes, the standard deviation would be higher, the volatility would be higher, but the risk would be less because you're paying less for the same companies. The value investor would see that he would get the company 40% cheaper, therefore his returns would be higher. That's a good thing. This leads us to a concept of market risk not discussed by mainstream media, but is always discussed by those who have beaten the market over extremely long periods of time. I'm talking about Buffett, Munger, Graham, Klarman, Lynch, and Sven Carlin himself. Those people know what they're doing. You have to listen to those guys, not every average Joe on the market. A value investor defines risk by the possibility of permanent capital loss. So the risk is how much you can lose while investing. But Wall Street can't use this definition because it is certain that any asset will drop 70% once or twice in your lifetime. Nobody would buy investment vehicles if the focus was on risk and not on returns. How much can I lose in the long term? Risk according to fundamentals. A different approach would be to look at the long-term fundamentals of a company and compare its long-term earnings to current price. You should check the current market environment and outlook if there are any headwinds or possibilities for permanent capital loss. So the key is to find the intrinsic value of a company and compare it to its price. If you buy the company at a large discount, then you have margin of safety and you minimize your risk. That is the reason why the most important factor while investing is not risk, but the price you pay. If you look at Standard & Poor over the last 11 years, you can see that the best returns came to the people who bought at the wrong time, back in 2008 and 2009, when everyone was saying that the stock is very risky and everything is very volatile and the standard deviation is really high, so don't buy it. That was the right time to buy because the price was the lowest. So more about how to do this fundamental analysis comes in the second part of this book. But right now, let's continue with this chapter. Before we go to the next part, think about this for a second. If you're willing to buy S&P at 2900, would you be willing to buy it at 1900? Let's say in the next month the price has dropped 1,000. Would you be thrilled or would you be scared? You should be thrilled because you can get so much more for your money. Most people think differently because the concept of risk is assessed differently. It is extremely difficult to change how people think because all these definitions come from academia and therefore are led into practical everyday life. Black swans and risk. Another concept of risk that can't be calculated into any portfolio is a black swan event. A black swan event is a concept best known from the books by Nassim, Taleb. It is an extremely rare event that has extreme impact on modern economic world and it cannot be predicted in any way. When a black swan comes, all the assumptions that keep the modern world stable fall and new assumptions are created. Fees always have a huge impact on asset prices. Everything starts to drop. Recent examples about the black swan event are the dot-com crash and the fall of Lehman Brothers. In hindsight, These events are easy to explain and easy to see why they happened, but no one can predict a black swan event. No one knows when another black swan event will happen, but we have to take into consideration that it might happen anytime. A value investing definition of risk. Quote, basically, we try to buy value expressed in the differential between its price and what we think it's worth. Walter Schloss. A value investor assesses the risk by the probability and the potential amount of loss. In order to assess the risk, we need to know what will happen in the future, but that is impossible. No one can predict the future. However, there are a few things you can do to counteract the risk. First thing is diversification. Secondly, a value investor hedges his position when appropriate and not expensive. And lastly, last part is the most important. A value investor invests with margin of safety, which means that whatever happens on the market, the risk for permanent capital loss is minimal. Take advantage of volatility, i.e. risk. Volatility shouldn't be considered as risk, but opportunity. If the price of a company drops and the fundamentals stay the same or drop less than the price, that makes it risky for academia because of the rise in volatility. But this will make it less risky for a value investor. We cannot avoid the volatility of the market, but we can avoid overpaying for our investments. We can avoid investing in companies that have deteriorating fundamentals. If you buy a company with good fundamentals at a discount, your risk is low because in the long run, the value will ultimately be reflected in its price. If the price of a company decreases temporarily and you reinvest your dividends every year, you can simply buy more at the times when the price is lower, and therefore in the long run you can get bigger returns. That is why volatility is something to take advantage of. Now, it is easy to get this point in a technical perspective, but it is difficult to apply this in a behavioral perspective. Nobody likes dropping prices, even if it leads to higher returns in the future. The author says that if the next time the prices drop and you're happy about it, then you have become a value investor. So you have something to wait for. Positive asymmetrical risk reward is the ultimate investing goal. The final concept to understand related to risk is asymmetrical risk reward. Understanding this will lead you to higher gains in the long run. If you want to beat the market, it is essential that you understand this concept. So an asymmetrical risk reward can be either positive or negative. A positive one is where you can lose less money than you can gain with the same probability. If you are patient and you fill your portfolio with positive asymmetrical risk stocks, then you're going to do extremely well in the future. From this author's picture, you can see a positive asymmetrical risk reward situation. The possible gain is from $100 to $150, with the same probability of a loss is only $10, so down to 90. So upside is $50, downside is only $10. So this is a positive asymmetrical risk reward. And from this one, you can see a negative asymmetrical risk reward, where the downside is down to 70, so you can lose $30, but the upside is up to 115. So upside of a $15, downside of $30. The problem with masses is that people focus on the returns and not on risk. It is extremely strong in the bull markets. For the last 10 years, markets have been rising, so people forget about their bad experiences and they only remember the good. By focusing on risk, you can find positive asymmetrical risk-reward situations, and you can gain so much security and so much money in the long run. Current market risk-reward example. The author brings an example from 2017 Standard & Poor 500. The PE ratio was around 25, which gives a yield of 4%. The economy was expected to rise from 1 to 3%. So the author doesn't see much of an upside there, so he calculates it to the yield to 5%. But on the risk side, there hasn't been a recession for 8 years. So there is a high probability for a recession. So the author assesses the risk for a recession in 5 years to 50%. So there is a 50% chance for a yearly return of 5% and a 50% chance that there will be a recession in the next 5 years. So if you put these into numbers, so let's say you put $100 in, you have a 50% chance that you're going to get a yearly return of 5%. So that will make from $100 to $127 in 5 years. Or you have a 50% chance that you're going to drop from $100 down to $50. The upside is $27, the downside is $50. So that is how the market was in 2017. How to apply positive asymmetrical risk reward into your portfolio. To find positive asymmetrical risk reward situations, you have to do a lot of research. You have to study businesses, do a lot of fundamental analysis. You have to take into consideration the cash flow, the price to book, cash per share, and other fundamentals that limit downside. Growth stocks usually have higher returns in the long run compared to companies that have high debt. The more stocks you analyze, the more positive asymmetrical risk reward situations you can find. The author states that it would take only 15 minutes a day to find a handful of suitable companies to keep an eye on. And when the risk reward is not in your favor, then you just have to wait. When the time comes, you buy. By being patient, you can do extremely well in the long run. Thank you guys so much for watching. I hope you liked this video. If you liked it, give me a thumbs up. Subscribe to my channel for more weekly content. If you like this book, go to Amazon and buy it. It's really good. Please learn this alongside with me. And also, if you like Sven Carlin, check out his YouTube channel and research platform. I will see you next week. Bye guys.